Good day, my name is Dean Crocker. I'm an equity analyst with the PSG Wealth team, and today I'll be taking through our latest EIA report completed on Reinet investments. So on the 26th of July 2021, Reinet released its first quarter 21 results. It was really just a management update as to their various NAV stances and any implied valuation changes. What was seen based on executive summary, NAV was down 4.25% to 27.97 euros per share, which equates to roughly about 473 Rand at date of release. BATS accounted for only about 35.5% and has seen a steady reduction over the past few years, whilst the Pension Insurance Corp has seen an increase in their shareholding or contribution to the results, seen at 48.8%. However, the NAV of the business was impacted by a low carrying value in the PSG, and this was following the reduction in the peer comparable price to NAV calculations, which they use in terms of their fair value calculations. Regardless of that, the company does still seem relatively cheap, trading about a 39% discount to its intrinsic value, and as such, we still maintain our overweight recommendation. With regards to the event, so as I mentioned, on the 26th of July 2021, the group released their first quarter 21 results. The NAV declined by 4.25% to 27 euros. The intrinsic value that we calculated, however, was roughly about 481.87 Rand per share. I will go through that in a bit more detail further on. The PSG, which is effectively Pension Insurance Corp, they did see a reduction in their fair value calculation, and it dropped by 8.7% to 2.5 billion. The impact of that was really driven by lower peer comparable multiples that they use for the valuations. In terms of capital commitments, there was capital commitments totaling 253 million, largely which was funded out of dividends received from BATS particularly. BATS 36 and PSG 49% contributed the largest to the NAV, and strangely enough, it's getting to a point now where those two contribute 75% of the total NAV of this business, thus remain the largest driving factors in Reinet. They do allow for cheaper entry points into these various companies, but it is just cognizant that those are the main drivers. In terms of price to book value, you can see that they are trading at a greater discount than they have historically, implying that there is some upside to be had. With regards to the impacts, the results were received favorably by the market. The share increased by 0.5% in early trade. However, Reinet has underperformed the benchmark by 0.56% since our last recommendation. Year to date, the group has underperformed by 10.9% with a full year to date return of only 5%. You can see historically it's quite a bit of a mixed bag, with them overperforming in the past 3 months. However, on a 1 year, 3 year, and a 5 year, they have underperformed the benchmarks. In terms of the assessment, so Reinet's price to NAV discount is currently trading at 39% based on our intrinsic valuation calculation. This is relative to historical discount of 35%, which implies that there is still some upside to be had. If we were to exclude BATS from the calculation, the discount narrows to roughly 6%. In terms of valuation, you can see in the table, BATS only contributed 9.81 euros per share, whilst the Pension Insurance Corp is at 13.96%. Pleasingly, we have seen an increase in the cash and liquid funds. This is a nice thing to have, particularly when there's a holding company that incurs debt to fund its subsidiaries, and as such is always a concern to us. However, given that they have a nice steady dividend flow from BATS and some of the other listed investments, they are able to meet their near-term liquidity requirements without having to sell any of their shareholdings in these assets. With regards to the assessment further, so the BATS investment historically has been decreasing. This is in line with management's discussion. They have used a lot of the proceeds from the BATS sales to grow their investment in the PSG as well as meet any short-term liquidity requirements, particularly in terms of capital commitments. This does also bode well for the business as they have a bit more of a diversified portfolio between PSG and BATS. However, the Pension Insurance Corp is becoming the largest investment, and thus quite a bit of risk lies with them. As I mentioned, Reinet is trading at 39% discount to a historical average of 35%, implying that there is some value. We are happy with the liquidity within the business at current. They have enough liquidity to meet any short-term requirements as well as to fund their capital commitments. Based on that, the investments that they hold are sound, they're solid, they're stable. They might not be in favor, particularly with regards to BATS, given some ESG concerns. And as such, the discount to NAV has seemed to be growing over the last few years. We do feel that it's a quick and cheap entry point into bats with the diversification then of the PICG. In terms of our valuation, it does still look cheap to us, trading at a discount greater than that its historical averages, and as such we've maintained our overweight recommendation. If you'd like to place a trade, please speak to your financial advisor. Alternatively, please speak to the trading desk. Please take note of the disclaimer and have a great day.